Hey guys, Scott Phillips here from scottphillipstrading.com, and today I wanted to follow on from the last video where we were talking about this incredibly important concept in tape reading where low probability outcomes cause the biggest moves of all. And I want to illustrate today how you can use this principle to design setups of your own making so that you can go beyond this sort of copy my setups, which are okay, or copy other people's setups, or just trolling the internet, and when you can start actually designing your own actionable price action setups. So what I want to do straight away is to look at this is the market for soybean meal futures, and as you can see, it's a very consistent downtrend. We have a double top, we have a strong kickoff to the downside, we have a very big move, and if you can see here just before it ends, the significant thing is, see this candle right here. See how this candle is the biggest candle in the whole trend. Now that's something that we often see very close to the end of one leg of a move. Now, in technical terms, what that is that's an increase in volatility at the end of a move. So a move with increasing volatility right at the end becomes very suspicious because volatility represents capitulation. So this candle here represents every guy who was thinking about getting short, was thinking about getting short way up here, but never bothered, and now finally I just have to get short here, and he gets short always at the worst possible time, and you can see this is where it starts to paint a sideways consolidation period. So we've got a very clear trend here. We've got any time that you see a giant big move at the start, you can naturally assume that it will probably have at least two legs. You know, it's reasonable to assume, and the reason for this is because any big move, there are guys on the sidelines who missed out, and they missed out, they're waiting for an opportunity. Any pullback is a shorting opportunity for those guys until proven otherwise. Now we have this period of sideways consolidation here, and you can see this is very demonstrative of one of the things that we know absolutely is true about price action, is that most attempted breakouts from trading ranges fail. And you can see I've got a two standard deviation Bollinger on this chart. It doesn't mean anything, it's just something I use in my systems. But you can see every time it's touched this upper Bollinger in this consolidation period, it's been an excellent short signal. So the odds are very strong that an attempted breakout from a trading range will fall. And eventually, after a number of tries, it's tried to break out once, twice, 3, 4 times. After it's tried to break out 4 times and failed, the odds become extremely strong that it's going to break to the downside. So that's something that you can use to design failed breakout systems. After a number of instances of failing to break out, you can design a setup to try and capture this second move down here. Now, let's look at the follow-up move. We've got a very strong kickoff to the move here. This first bar here is a complete rejection of the range trading thesis. So if you believe that the market was going to rally, you would hope that it would find support here, but it didn't find support. It smashed through support, closed below support. At this point, the fix is in, and you know that everyone who was a bull in all this consolidation period is bulls getting set. Bulls getting position, bulls thinking that the move is over, bulls anticipating a short squeeze. Right here, these guys have to start covering. There's absolutely no way known that you can look at this and say, oh wow, it's just going to come back. So everyone is ditching their positions there, and it's a good time to catch a better move. Okay, so what happens here? We have a normal counter trend rally. Now let's go a bit deeper with the rally, and we see what's happened. We've got a couple of overlapping bars. We've got a break of the shooting star high, indicating that we're probably going to have a more substantial correction. We've got these bars, one up, one down. 60–70% of the range is overlapping with the previous range. Here, probably 80% of the range overlapping with the previous range. But this bar is a failed attempt to drive the market up, indicating that we should have selling pressure, but we don't have selling pressure. We actually break the high of this candle, indicating that we're probably going to have at least 1 or 2 more days of rally. And we do before the influence of the previous trend takes over and we start to go down again. So what we have is we've got a very clear trend. It's a very clear bear trend. Now, I want to stop just here. So this is the position on Friday, and this is the trade that I took. And at this point, we have a very proportional, perfect-looking sideways period and a pullback and a shooting star. This is an absolutely textbook sell setup. Previous trend, everything's all lined up. You would say that 8 out of 10 traders would look at that and think that that market's a sell. And I looked at that and thought that it was a sell also. But I always like to play with my setups. A lot of them are designed around what if. So the more higher probability something is, when that doesn't work out, all these shorts are going to have to cover. So what I did is I want to show you this failed shooting star setup. So this is a shooting star candle right here. Okay, now the shooting star is a failed attempt to drive the market up. So I always like objective definitions for things. My definition is that it's got to close in the lower half of the range. It's got an upper wick equal to or greater than twice the real body, and the real body is the distance from the open to the close. And it's very definitely a failed attempt to drive the market down. And the rationale for getting short here is after a failed attempt to drive the market up. After a failed attempt to drive the market up, the market will almost certainly want to try and go down because of the exhaustion of selling pressure. Now, if that doesn't work out, and the more textbook your sell setup looks, the more you want to be alive to the possibility that what if it doesn't work out, because we know for sure that low probability outcomes cause outsized moves. So an example of a setup that you can create actionable results from is this failed shooting star setup. So the market should break the low of the candle, but what if it doesn't? What if it breaks the high of this candle instead? At this point, I no longer want to be short. I want to be long. And if you look at all these people who are short from all the way in the previous trend, where is the obvious place for them to place stops? Now, I'm going to show you the places where I would place stops if I was a long-standing trend follower. I would have placed my stops first here, then here, then here, and now here. So what happens if we rally and hit those is we're going to have an enormous number of stops. And what happens when those stops get triggered? We can be almost certain that the market will rally straight up once those stops are triggered, because the stops triggered are buy orders, right? Okay, so just so you can see that, actually I took profit. So I'll change the NinjaTrader settings to show exactly what happened here. And okay. So I got my entry was here, and I immediately banked profit here. It was a one bar, one and done move, very high probability of working out, and that's what I did. So I want you to think about using this principle not just to aid my setups, but where are the things that you have seen in your trading that you think are really, really high probability outcomes, and then start to look at what happens if those outcomes don't eventuate. So we want to get away from this idea in technical analysis of I know the future, which doesn't work very well, and we want to get towards what are the odds. So anytime that we see that the odds of something happening are only 20 or 25%, we know that if something that's only a 25% chance of happening actually happens, wow, we're really actually onto something. And there's plenty of ways that you can use that in your own trading. So I want to show you one more thing before we go. So I'll pull all the crap off the chart. Okay. This is the emini, the S&P 500 futures contract. So again, we've got a very clear and smooth uptrend in the September month. And let's drill down to a bit of detail and move on from what we discussed the other day, which is that the market really should have followed on from here, but didn't. Completely rejected that idea and came down here. Now, what we have here on Friday is this bar. It's both an inside bar and it's a shooting star. So what this is we're holding the line of the bottom of the trading range is about here. We can reasonably say that if it breaks below the bottom of this trading range and closes, we're off and running to the downside. I think that is a reasonable hypothesis at this point in time. And there's excellent risk-reward odds on offer if that happens. So how are we going to trade this? I'll show you how I'm going to trade it. I'm going to show you, this is a trade I'll be taking on Monday, and I'm going to show you how you take it if you're a longer-term trader and how you're taking it if you're a shorter-term trader. So, the trade I'll be taking is an entry point at this line with a stop loss at this line. Okay. Now, if you wanted to, that trade there will have win odds of somewhere approximately 50%, and it'll have an expectancy of about 0.21 based on through a lot of data. It's a positive expectancy trade. If you're uncomfortable with 50-50 win rate trades, which people are, you can raise this win rate at the expense of the risk-reward ratio by increasing your stop. And this is a very useful trick and a conceptual concept which you can take into a lot of things in trading. If your win rate isn't what you want it to be for your system, you can tweak it by using a wider stop. And the two obvious places to place a stop here are here and here. So if you wanted to take the bet that this was the start of, a change of trend or a very substantial correction period, I would place your stop at the top, and the risk is between here and here, and you adjust your stop loss accordingly on the way down. Myself, I'm a much shorter time horizon trader. My average hold time is only 3 trading days. So, and most of my average losing trade is one and done in 18 hours. So for me, it makes sense to have a tight stop loss, bank a quick gain, and move on to the next trade. So, an in-between strategy might be to place your stop here, which should not really be, if your bearish thesis is intact, this stop loss should never be threatened. It should drop away before it hits that. Now, one thing before I go is the advantage of placing your entry here on a stop trigger, so we're not entering until price falls below there, is what if we're wrong? I'm wrong all the time. There's stuff, couple of days ago, I expected the market to rally and stop me out, but instead it dropped. And all the time, because most of us don't keep proper records, we fool ourselves. We think we know what's going to happen, but the evidence is that we really don't know what's going to happen. And that goes for me as much as anyone else. So because my default thinking is that I don't know what's going to happen, lost my train of thought. Completely lost it. So for me, my default thinking is, the ideal thinking is that I don't know what's going to happen, and I want to stay alive to the possibility that I might be wrong and that things might be changing and blah blah blah. Okay, guys, so that's all for today. Thank you very much.